All right, people, if you look at the canvas, we have this announcement that our second midterm exam will be this Friday on June the 19th. It will be posted at noon, and you will have 24 hours to finish it and upload it through Canvas. The chapter covered in the exam will be chapters 6, 7, and 8, and please just be on time. The reason I cannot hold a virtual in-time conference because I had a toothache and I was taking Advil and medicine just to keep up. So I cannot guarantee that I could speak well when we were in a meeting. So sorry about that. So therefore, I'm recording this video clip as a review section for your exam. I hope you guys would understand. Alrighty, so in the Canvas, you will have a file called a review of a second exam. Actually, I just downloaded and I'm going to revise a little bit because in the file before there was chapter 14 that would be covered. However, in this semester, we are not covering chapter 14 for the midterm. It will be in the final. All right, so these are the chapters covered. And also remember, in chapter 7, we are doing a little bit of extra stuff. Chapter 7 is about options and futures. And because the Graham School Management received sponsorship from the Chicago Mercantile Exchange, so as a fulfillment of that sponsorship, we need to, the Department of Finance, need to put more curriculum about the education of futures and options. So I added some more stuff. It's about the combination of options like a straddle and a strangle and bull spread, bear spread, standard options and stuff. So you will need to study those stuff as well. And chapter 8 is about transaction exposure. Again, it's about utilizing derivatives to hedge the risk. In addition to the financial products, you also need to know some techniques, operating techniques to hedge the exchange risk. All right. So for your second exam, the structure of the questions would be similar to your first exam. There would be conceptual questions, analytical questions, computational problems. Okay. So the total here is 110%. 110%. So I just want to give you some extra point. So if you scored 110, then you get 110 out of 100. So that's 10% extra credit we're talking about here. In terms of types of question, you will have multiple choice questions, numerical solving questions, and also essay questions. All right, for chapter 6, it's about parity relationships. We have learned three core parity relationships. These are interest rate parity, purchasing power parity, and Fisher effect. In chapter 5, we learned covered interest arbitrage and how to calculate the covered interest arbitrage. Right here, we still need to know how to do the covered interest arbitrage because that's one of the preconditions for the interest rate parity to exist. So I know that I require you guys to know how to do covered interest arbitrage in the first exam. And if you have a question of a covered interest arbitrage in this forthcoming exam, it will be considered extra credit. All right. Although in the first exam that question was not asked, but it could be asked in the second exam. And if it's asked in the second exam, it would be extra credit because it was a requirement for the first exam, which was not cumulative. Actually, none of our exams is cumulative. Alrighty, so for interest or arbitrage, you should know that if you have a situation, an opportunity to invest domestically, so this is a U.S. interest, so it should be the same as you invest overseas if you convert with the spot rate and invest in the foreign country. and then after you get the interest in the foreign country, you will convert it back based on the forward rate. All right, and these are the nominal interest rate, and according to the Fisher effect, so we can see that 1 plus the U.S. inflation over 1 plus the foreign inflation, it equals to 1 plus U.S. interest rate over 1 plus the foreign interest rate. I believe that in one of the video clips I posted about the power relationships, there were some errors, but here is the correct version. So this is based on the Fisher effect. And in Fisher effect, we hold that the real interest rate in the US equals to the real interest in the foreign country. All right, and back to the interest rate parity. Let's say interest rate parity. You should know that when this parity relationship is violated, then there will be associated change. Okay, so if this is violated, then you should expect that the left-hand side will become smaller and the right-hand side will become larger. So the left is become smaller, the right will become larger. So you will see all the four factors would have a direction to change. Okay, and if the right-hand side is getting bigger, you should expect the left-hand side is getting larger and the right-hand side is getting smaller. So this is getting larger, getting smaller, getting larger, and getting smaller. Okay. So if this the red color, if this situation applies, then you should know it is about the U.S. interest is getting too high, and then the foreigners will invest in the U.S. If the blue situation applies, then that means the U.S. interest is too low. Then the American investors should invest overseas. All right. And then we also learned the purchasing power parity, and you should know how to calculate the overvaluation and undervaluation. That is your one of your quizzes. Okay, the formula is the actual rate minus the PPP exchange rate divided by the PPP exchange rate. So that's a formula. And the PPP exchange rate basically is the US dollar price divided by the foreign currency price. So this is your PPP rate. Okay, for example, if a Big Mac in the United States is getting $4.1, all right, and if it is 12.3 Chinese yuan in China, so the PPP rate for Chinese yuan should be $0.33 for Chinese yuan per Chinese yuan. Okay, and then based on the actual rate, you can calculate the overvaluation, undervaluation, and you should know that under the purchasing power parity, if the inflation changes among the two countries, so that would make the price change. So inflation change would lead to the price change, and the price change will push the actual exchange rate to change. Okay, and how do you incorporate the inflation change? So let's say the exchange rate in the next period equals to exchange rate in this period times 1 plus the dollar inflation over 1 plus the foreign inflation. Okay, for example, if US inflation is literally 0 and the euro inflation is 2%, and right now the euro rate is $1.1 per euro, then you can just put in the equation, then your ST plus 1 would be 1.1 times 1 plus point, actually it's 2%. And this will be 1.122%. Sorry, it's a dollar per euro. Okay, so this is how we do the calculations in the questions related with chapter 6. And for the conceptual stuff, you should know how to connect this Fisher effect. This is a Fisher effect, and this is purchasing power parity, and also this is the that was the interest rate parity right here. This is the purchasing power parity. All right, and so when I lay out a formula for you or an equation, let's say 1 plus the U.S. interest over 1 plus the foreign interest. So this is a forward over spot. So you should immediately know this is interest rate parity. And if I equalize this part of the equation to 1 plus the U.S. inflation over 1 plus the foreign inflation, then you should immediately recognize that this part, this part is the interest, is the purchasing power parity, okay, is equalized by purchasing power parity. By Fisher effect. This part is equalized by Fisher effect. And then if I put the spot rate in the future or one period after over the spot rate right now, you should know that this is a purchasing power parity. Okay, so let me just be more specific. This part is purchasing parity, and this part is internal interest rate parity, and this part in the middle is a Fisher effect. Okay, and the parity relationships can be rewritten as like this. So you will see the exchange rate change. So that's the amount of appreciation or depreciation in percentage. That is roughly the inflation change or inflation difference between the two countries. And the inflation difference is roughly the interest rate difference between the two countries, assuming the real rate is the same. And the interest rate difference would be roughly the forward premium, which is the annualized forward minus spot divided by spot. This thing is called a forward premium. So you should know that this is given as a purchasing power parity, and this part is given. If you equalize this part together, this is an interest rate parity. And if you equalize these two together, these two difference, this is a Fisher effect. Okay, so this is a purchasing power parity. Alrighty, so that's basically about chapter 6. So all these relationships. And for those concepts, you should know what is relative form of PPP, what is the absolute form of PPP. So basically, under the absolute form of PPP, there is no overvaluation or undervaluation of a currency. If the price changes in one of the two countries, then the exchange rate would immediately adjust to the extent that no overvaluation or undervaluation exists. But under the relative form of PPP, we admit that due to the transaction cost and the market frictions, there could be over or undervaluation of a foreign currency. Okay, that does exist in the relative form PPP. However, when the interest rate, when the inflation of the two countries changes, then the exchange rate, the actual exchange rate, would adjust to the inflation change. Okay, and once again, to do the covered interest arbitrage is the implement the strategy per se is an extra credit of the class of the exam, but you should know that after you have done the covered interest arbitrage, what would happen to the four factors. For example, what happened to the forward rate, what happened to the spot rate, and what happened to the domestic interest and foreign interest due to the activities of a covered interest arbitrage. And you should also know there's a demand supply analysis. For example, if people keep borrowing from the US money market, that's going to increase the demand of the loans in the market. That's going to push the interest up. If people keep investing in the foreign market, that's going to increase the supply of money in the foreign market. So that's going to push the interest rate down. And how to calculate the interest, the overvaluation, undervaluation is also the requirement for the class. And how to calculate the exchange rate change, that's also a requirement. And also what happens if one of the two countries has higher inflation against the other, what would be the result of the exchange rate? Is that going to appreciate or depreciate? This is something we covered before. And in this chapter for the exam, you don't have to analyze what happens to the export and imports of the two countries, what happened to the demand and supplies of the two currencies. You just need to remember when the inflation of one country increases more than the other country, then that country's currency, I mean the domestic currency, will depreciate. So higher inflation, the lower value of your currency. So that's a rule. And in terms of calculation, this is something you need to handle. All right, for chapter 7, you should know what is option, futures, and forwards. You should know the differences and the similarities. Futures and forwards are more similar, except that forwards is more individualized and the futures is more standardized. And the futures and options, these are all securities supervised by the U.S. government. It is the Commodities Trading Commission who is overseeing the activities of that. And also you should know for futures and forwards, no matter you are a buyer or seller, there's always an obligation for you to buy or sell. But for options, there's no obligation for option buyers. It's just an option, a right to access the option or not. However, if you are an option writer, then you will be in the obligation to fulfill the trade if, okay, not in every case, if the option is exercised. All right, so there is an obligation exist for option writers if the option get exercised. And you should also know what are the determinants of option premium. So option premium is the price of the option. You need to think option as two things. One is option is an insurance. So what makes the insurance more expensive? When the situation is more risky, all right, when the exchange rate is more volatile and the maturity of the option, the time is longer, then this situation is risky, so the option premium would be higher. Okay, the second thing you treat option should be an investment. So option can make money for its buyers, or even for the buyers. And if you can make more money from this option, then this option should be more expensive. And then you should know the concepts of American options and the European options. So basically, American options can be exercised anytime before expiration, and European options cannot be exercised before the expiration or maturity. And you should know the concept of in the money, out of the money, at the money. So at the money is a break even. In the money means if you exercise the option today, you can make profit. Out of the option means if you exercise the option today, at this status, you will lose money. All right. And for the option combinations, so these are the coverage. You have a straddle, strangle, cat cylinder, bull spread, bear spread. So these 5 combinations is something I added in addition to the textbook material. It's not that hard because I will tell you what these combinations are made of. For example, in a straddle combination, there is a put option, there is a call option combined. So you are buying a call, buying a put, and these two options are having the same access price. And how to get the profit under a specific spot rate, then you just need to calculate separately the profit for the call option and the profit for the put option. Okay, and likewise, I will tell you what the strangle is made of, what a boot spread is made of, and then you will basically calculate separately for each of the component option to see their individual profit and then add them up. So it's not hard. So instead of calculating one option, you just calculate two options, giving a specific spot rate. And I could give you more than one specific spot rate. And for the exercises, you should refer to the second assignment, and you should refer to the Excel practice I posted on the Canvas. And you also need to know what is a break-even point. So break-even point indicate a spot rate that make the profit of your position to zero. Okay, the spot rate can be somewhere that make your overall profit to zero. All right, so that's your break-even point. And you should know how to solve for break-even point for certain option combinations and also for certain individual options. And also, you should know what's the goal of holding the options or other derivatives like futures and forwards. So basically, you are trading based on your expectation. If the currency is going to appreciate, then what you should do. If the currency is depreciating, what you should do. And you can check the quiz 6 we just did. So basically, you have this quiz 6. Let me just open it up briefly. Quiz 6. All right, so right here you're looking at an option. So it tells you that the maturity will be September this year in the future, of course. And this is the price today. And if you believe the spot rate will be 1.15, so you should buy the futures, and that's gonna obligate you to buy 1.12. And then based on your belief, you can make a 3 cents profit per euro based when the time comes. And this 1.15 is a spot rate. If you are trading futures, you are a speculator in this case, and you will need to clear your position, because at the end of the game, you don't want to hold 125,000 euros because you are now traveling to Europe to buy a Ferrari or to spend a 3 months vacation. You're gonna sell these euros in the spot market, all right? And that's gonna make you clear your position. So if your belief becomes true and the spot rate does become 1.15 at the time of maturity, you are making a profit. So right here, you should buy the futures, and this is the truth, and that's gonna obligate you to buy at 1.12. And right here, you will need to sell at the spot rate, at the prevailing rate, and that's true also. Okay, as I said, you need to clear your position. And right here, just one day after you change your belief because you get some more information, and you believe instead of it's 1.15, it's going to be 1.09, which is below the futures price, then you should take a short position by selling the future. If you sell the future, you will sell at 1.12, and then you believe that you can buy at 1.09 at the time of the maturity. So you should sell the futures tomorrow and do nothing. And when the time comes, you will be obligated to sell actually at 1.12, and you hopefully to buy at 1.09. So this is about buying at 1.09 from the prevailing spot rate, and then simultaneously sell at 1.12 at the futures rate. So this is a false. Okay, and I saw people did pretty well in the profit calculation, so that's a good part. Alrighty. And for the futures, you should know the difference between the futures, the spot rate, and the prices. And you should know how to make an arbitrage uh, based on the futures. So if you see two futures, you buy one and sell the other, and hopefully you can lock in a price, uh, lock in a profit from the price differences of the two futures. So this would be considered very easy and straightforward, just to make sure the size would match to each other. All right, this would be definitely on your handout when you're doing the exam. So what you're gonna do with the options. So you should know that a call option gives the option buyer the right to buy the currency at a strike price, which is a fixed, predetermined, and the put option gives the option buyer the right to sell. Okay, and the situation will be different whether to access the option or not. So if the spot rate is greater than the strike for call options, then you should exercise it. When you exercise it, you're gonna buy at the lower strike price and sell at the higher spot rate, and that's how you make a profit. Okay, so you gotta make a profit based on the price difference between spot and strike, and also for the option buyer, you're gonna pay for the premium. And if the spot rate is getting lower than strike, then you will need to stay calm and just let the option expire. So in that case, you just suffer a premium just to pay for that insurance without exercising, without the insurance claim. So your loss would be just the premium. And for put option, if the spot rate is getting too low, that's good for you. Congratulations. You can lock in a profit by selling at a strike. Okay, that's what put option is about. It's giving the right to sell at a strike, and then simultaneously to buy a spot to clear your position. And then you are making the profit strike minus spot, and also you are paying the premium. If spot rate is getting too high, so that's the bad news for the put option writers. Put option buyers, and then you do not exercise the put option. You just let it expire. Well, what happens if you access the put option when it's out of the money? You just ask for additional losses in addition to the premium you paid. All right, and as a rational trader, you don't want to do it. Okay, when the option is out of the money, you don't exercise the option. So this is the profit for option writers who are the seller or the creator of the option, or the gambler on the other side of the game who is betting against you. So so everything's the same except that the option writer's profit is just exactly the opposite or the negative of option writer of the option buyers. Okay, so what you can derive from here is that option trading is a zero-sum game. The total profit for option buyer and writer is zero. Okay, and they both are paying transaction fees to the CME, the Chicago Mercantile Exchange. So that's why they always make money. Okay, and conceptually, you should know that the option writers would have the right to they don't have the right. They would have the obligation to fulfill when the option is exercised. Okay, if the option is not exercised, they don't have that obligation. Okay, and for the some analytical questions from option chapter, so you should know what is the difference between straddle and strangle, and why are we using that? Because the straddle from its profit curve, if I draw a straddle right here, it goes like this. Okay, this is the spot rate and this is your profit. So basically, if the exchange rate is getting very low, you make a profit. If the exchange rate is getting very high, you also make a profit. If the exchange rate is getting stable, you make a loss. So you're betting on a very volatile market, so you can profit from both ends. If you are thinking the exchange rate is going to be stable, then you should be on the right hand side of the straddle. All right, so this is the short and this is the long. Okay, and how to calculate the break even? You should first equalize the formula for the profit of a position. For the call option, your profit is the spot minus strike, because strike is what you pay for, minus the premium. Okay, so you equalize to 0, then you solve for the spot. And for the put option, it is the strike. You sell at strike with the put option minus the spot. You take the opposite to clear your position, then minus the put premium. You equalize to 0, and then you solve for the spot. Okay, and if you have the strangle or straddle, then you basically just get the profit of a put and a profit of a call, all right, equalized to 0. You solve for the spot. Okay, so that's the break-even point. Okay, for chapter 8, it's about hedging transaction exposure. So in this chapter, although we are dealing with the same options, forwards and futures, but you are switching a role, Peter. You are not a speculator in the market. You are actually a multinational corporation. Okay, the difference here is in chapter 7, when you're playing futures, when you're playing options, you always clear a position by doing another trade in the spot market. Okay, so if you buy a futures, like what you did in your quiz, if you buy a futures, then you will need to sell at the spot rate to clear a position to get the price difference as a profit. However, if this chapter you just do one side of the trade. Okay, if you are a exporter of a company, okay, and then you will receive currencies, foreign currencies, as a payment to you for your product sold to your foreign partner. So if you receive, let's say, 10 million pounds, then you will need to sell the 10 million pounds and get it to US dollars. So the thing you could do is to either sell the futures, 10 million pounds of futures, or sell 10 million pounds of a forward. That's one way to do it. Or you can buy a put option, all right, and then sell it at the strike price of the put option, which is predetermined and fixed, so you don't have to worry about the volatile rate of the British pound. Okay, so these are the catch of the story. So when you're selling these pounds, then you don't need to do the spot market trading at the maturity. So that's, again, just the one side of a trading. You don't have to clear a position because you just receive, you just want to hedge with your receivables and payables, and you don't have to, you don't clear your position as speculators. Okay, so here are some techniques. Here are some techniques are related with operational techniques, and you don't have to get into the financial market. You just do some arrangement on your operating side. One is to select the choice of invoice currency. Okay, so we are under the framework of having the controlling the exchange rate risk. So if you are exporter, then you will receive foreign currency. Let me just write it down here. If you are exporter, all right, this is for multinational corporations. You can be exporter, you could be importer. So you can receive, if you're exporter, you will receive foreign currency, or you can just make the transaction invoice US dollars, so you don't have to worry about the exchange rate. But if if you receive foreign currency, then you will have to worry about the exchange rate, and then you will find a way to get it fixed. So if you that's gonna be account receivable in foreign currency. If you're an importer, then you will need to pay in the foreign currency. So that's account payable in foreign currency. All right. So that if you receive foreign currency in the future, that indicates you will have the need to sell the foreign currency upon receiving it from your vendors, actually your clients or customers. If you have payables in foreign currency, then you will have the need to buy the foreign currency from the exchange market to pay your vendors. All right. So, what financial products would give you uh, the right to sell? So this basically can be hedged through several things. You can take a short position in the futures, okay, or short position in the forward. Okay, it's the same thing. All right, and then you can also buy put option, which give you the right to sell at a fixed rate. If you are having the need to buy it, then you will need to take the position to a long, okay, futures and the forward, okay, and then you will also need to, you can also need to buy call option, which give you the right to buy at a fixed rate, so you don't have to worry. And also you should know that if you sell at the if you sell the foreign currency, you will have the need to sell foreign currency. There could be two situations. If a foreign currency appreciates, then you're gonna sell it, you would get more dollars. So this is a good situation for you. So this is a good. If a foreign currency goes down, then you will get less dollars. So that's bad for you. And you want to prevent this bad thing from happening by doing this all this financial product thing. So this is called a hedging. Hedging means controlling risk. And if you're looking at the buying side, if you are worried about the account payable in the foreign currency, so there could be two things. Either the foreign currency appreciates, then you will need to spend more dollars for the same 10 million pounds, then that's bad for you. Okay. If a foreign currency depreciates, then you will need to spend less dollar to buy the same amount of pounds. So that's good for you. So if the bad thing happen, then you will need to find a way to prevent it from happening. So that's called a hedging. Alrighty. So if you look into the this chapter 8, you should know what lead and lag strategy is. So basically that's about paying early or paying late, depending on your expectation of the direction of change of the currency. And just make sure you check the detail of that. And for all the other three within the operating techniques, those are pretty easy to understand. You can either make your invoice currency more domestic biased, make it more in dollars. That's actually what's happening when US is trading with developing countries because they love dollars. So you don't have to worry about their risk. And you also have a exposure netting. So that means when you have a two department, one is receiving the currency, another is paying the currency, you want to make sure you combine these two cash inflows and outflows in the same foreign currency, and then just control the residual risk. And you also have this contingent on options. So basically, if you are looking at a foreign project, you're bidding with other competitors in the world, and you don't need the foreign currency if your bid fails, but you will need the foreign currency if your bid succeeds. You will be the supplier for the project, and then you will need to get the foreign currency, buy the foreign currency, and then start the project in that country. So the best fit in this scenario is to buy a call option, because a call option gives you the right to exercise it or not. So if your bid failed to your competitors, then you don't exercise the call option, just let it go. If you succeed in the bidding process, then you will need to utilize a call option to buy the foreign currency at a fixed predetermined rate with no risk at all, and then use the currency you buy with the call option to launch the project in that country. Okay. So what poses challenge here in chapter 8, I actually want to scroll down here. So right here how to use the option market to hedge. So you should know it very well, either conceptually or computationally. All right. So what you would see in the exam is that I would give you questions. All right. I would say this company has foreign currency receivable. Okay. So that means if you ever want to hedge with options, you should buy put options because that give you the right to sell at the strike price, which is fixed. Okay. And I will also ask you what under one specific rate, what will be your choice and what will be your net dollar proceeds. Okay. And I can ask more than one specific spot rate. I could ask you 5 spot rates. Okay. And you will need to know under each spot rate, possible spot rate, what would be your access decision? Do you let the option expire? You exercise it? And what will be your dollar proceeds? And also, if you are trading options, no matter you are buying put option or buying a call option, you always pay the premium as a buyer. And if you calculate the option cost, which is from the premium, it should be the future value of the option cost because that we're talking about the payment 1 year later. But if you buy the options, you're going to pay the money now. So you really have to consider the time value of the money by compounding the money you paid right now for the option into a future value. And you're going to use the US interest rate, of course, to do the compounding. Okay, so this is your dollar revenue. If the spot rate is pretty low, then you should exercise the call option, the put option, I'm sorry. That is different from your speculative position. Okay, you access the put option, and then if spot rate gets high, so you don't access the put option, you just enjoy the upward trending of the spot rate. Just take advantage of the higher spot rate, sell it at higher spot rate, and getting more dollars received. But if spot rate is getting very low, then you just access the put option, and then as you can see, you can hedge your risk of plummeting the dollar proceeds. And this is a picture of buying at a put option in the speculative market. As I said, in the speculative market, you're a speculator, you buy and sell, clear a position. There are always one pair of trading with one in option, another in spot rate, okay? Or one in the futures, another in the spot rate, okay? So if you clear a position right here, if the spot rate is getting too low, you access a put, you sell it at a strike, then you buy it at a spot. The difference would be your profit. If the spot rate is getting too high, then you don't access a put, then you just suffer the loss from the premium only. Okay, and if you're an importer, in this case, the previous case was exporter, you receive. If you're an importer, so what did I say? If you're an importer, then you will need to pay foreign exchange. You will need to buy the foreign exchange with your dollars so you can pay your foreign vendors. So you want to hedge the risk when the foreign exchange is appreciating, so you don't have to pay too much dollar for the same bill. Then if that's the case, then of course you're going to use a call option because call option gives you the right to buy at a fixed rate. And be careful when you are considering the call premium, make sure you have to compound it into future value because you are paying the premium now, but when you exercise it, it's going to be in the future. Okay, so this would be the dollar cost for you. This is directly from the textbook. So if the dollar is getting very low, the British pound is getting very low, let's say if it's $0 for 1 British pound, then you just need to spend the premium money. This is the premium money. And if the spot rate is getting higher and higher, then you don't exercise the option basically from here to here. You just take advantage of the low exchange rate of a British pound. All right, so you spend a very low minimum amount of dollar to get the same British pound, and that's good for you. But if the British pound is getting too high, then you will find a way to hedge the risk. The way you hedge the risk is to exercise the call option and buy it at a very reasonable fixed rate. So no matter how high the spot rate of British pound gonna be, you always pay at the strike price of the call option. So your cost is always capped. All right. The last subject, actually, I think is pretty hard, is money market hedging. So you are using the short-term loans. When I say short-term, that's within 1 year, of course, to hedge the risk of a receivable and payables. So if you are dealing with foreign currency receivable, then you will need to borrow in the foreign currency. And if you are dealing with foreign currency payables, you will need to lend in foreign currency. So let me just write it up here. So if you have receivables, then you will borrow. Let me write it red. Borrow at the foreign interest, okay? Or you borrow from the institution in your partner's country, all right? If you're dealing with the payables, then you will need to lend at the foreign interest, okay? So what happens there is if, let's say a year later, when the due date comes, then you borrow, then you will need to pay principal and interest, okay? Pay at the foreign currency, because this is what you do today. And this is what you do at the due date. So you will pay it back. Pay it back at the foreign exchange rate. All right. So when you pay it back, you remember you receive this foreign currency here. So you want the money you receive from your exporter partner to be exactly the same as the money you paid to the foreign financial institution or the foreign bank. Okay, so that way the foreign currency would get canceled. Here you get it canceled, and here you get it canceled. So you have a zero cash flow denominated in the foreign currency. Okay, so that's how we implement the hedging. Likewise, if you lend today at the foreign interest rate, then you will need to receive the foreign currency, okay, receive it back with principal plus interest, of course, and then you will be in the need of paying the foreign currency to your importer partner from whom you buy things from, and you're going to pay them the foreign currency. And the catch here is to make the money you receive in foreign currency exactly the same as the money you pay to your foreign partner. So this way it got canceled and this got canceled, and there's a zero foreign currency cash flow. Like here, zero foreign currency cash flow. So in the future, we do not deal with foreign currency cash flow at all, because actually we're dealing with two foreign currency cash flows, just the net is zero, so we don't deal with any risk at all. Okay, so that's the zero risk. So that's the whole story or the strategy of the thing. And you need to calculate in this lead and lag strategy, in this money market hedging strategy, you need to calculate how much money you need to receive a year later in terms of dollar, okay? And it just to tell you exactly what you need to do here in the chapter. So if you have any questions, you can just email me or call me. And I know that we are still 4 days before the exam, so you still have some time to study for the 8 chapters, so you don't have to be worried about it right now. Just to go over the review, the videos for chapter 8 to see all the details. Since this is a review class in this video clip per se, I'm not going to that much of detail. I really like you to review that chapter 8 video first before you, and then take a look at this review video.